Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now, the first couple of analyses, the charts and, news and fundamentals, I know there's a few experienced traders out there who are saying, yeah, I know this. I do this all the time. Get to the good stuff. Well, okay. Here's the good stuff. I said before, I kind of mentioned this in passing. I didn't go into a lot of supporting detail, and I don't know if any of you actually caught the phrase that I used, but I referred to stocks and currencies in the spot markets and futures as linear products. They're linear. If you're long it, it goes up, you make money. It goes down, you lose money. That's it. Story's over. There's not much more to them. You know how to read a chart. You know how to read a blog, a website, and you have half a brain. You can go and trade it. Can't guarantee it'll make money, but you can trade it. It's not hard to understand. Options, though, are a little different. They're a little more multifaceted, and they're multifaceted because of the time value in an option. And the time value exists because of the potential for volatility and the uncertainty of the direction of volatility. Whenever you make a trade in options, you're trading volatility. Now, that may sound like maybe kind of a strange statement. How do you trade volatility? Well, here's how. Let's talk a little bit about the context of this word I'm throwing out there, volatility. There's two types of volatility, realized and implied. Now, realized volatility, for those of you who are listening to me, I know what volatility is. Realized volatility is the kind of volatility that is intuitive. I asked my 11-year-old kid, what's volatility? He's going to give me, basically a loose definition of realized volatility. When stocks go up and down, or currencies go up and down, or futures, realized volatility measures how big the movements are. How volatile is it? You kind of want to quantify that. When you're comparing two different currencies, well, which one is more volatile? I'm looking at the charts and, I don't know, it's kind of hard to tell which is more volatile. Well, we do have a tool to answer that question, and that tool is called standard deviation. Standard deviation is basically a mathematical measure of exactly how volatile a currency has been over a certain period of time. Typically, it's 30 days. And then we take that 30 days and annualize it to make it representative of a full year, of 12 months. So realized volatility, you might also hear referred to as historical volatility, statistical volatility, or the volatility of how volatile a currency has been. Okay, that's kind of the easy one. But when I say whenever you make a trade using options, you're trading volatility, I specifically mean something different and something very, very special in the options world. The volatility that I'm referring to in that statement is called implied volatility. Implied volatility is the volatility component of an options price. You may be looking at two assets, whatever kind of asset really. Could be a currency, stock, future. And the at-the-money calls, the August at-the-money calls might be $4. And then you could find a different asset in the same asset category that's trading at the same price and look at its at-the-money call, and it might be trading at $7 or $8. well, why is one trading for a high price and one is trading for a low price? It seems like they ought to be pretty close to the same, but one's obviously more expensive. Well, that's because of the implied volatility. Options can be cheap or expensive based on what? On supply and demand, on how much people want them. And the reason that people want options, to make a very, very general but true statement, is because of volatility. Hedgers out there, they want to buy puts to protect themselves when they think that a currency is going to be more volatile in the future. Speculators, well, if they believe that a currency is going to be more volatile in the future, well, why would they go and buy the spot currency? I know that these things can move around a lot. I want the opportunity, not the risk. I'm better off trading options so I could limit my risk. I'm going to buy options if I think it's going to be volatile in the future, not the spot. And plus, there's more opportunity to make money if I'm a leveraged shooter kind of guy. So volatility, when we perceive future volatility to be higher, option prices get more expensive, and that is called implied volatility. You're trading it. Every time you make a trade, you're trading it. So because of that, just like when you make a trade in a currency, you'll look at a chart, you read the news, figure out if you think that currency is cheap or expensive within its currency pair. You do the same thing with the volatility of the options you're trading. Well, if this volatility is expensive, should I be buying it or selling it? Because if I'm bullish on a currency, I can get long it by either buying or selling options. I can take a bullish position in a number of different ways. This is where we get to kind of fine-tuning and making some smart decisions about getting edge and being able to select the correct strategy. The strategy where we can kind of squeeze as much out of it if it turns out to be a winner for us, and lose as little as possible if it turns out to be a loser for us. Now, if you've never looked at volatility before, the screenshot I showed you before, I kind of cut off the bottom because I just wanted to show you the chart. It's all there as well. And now look, I encourage you every single time you make an option trade, every single time, you can look at your chart somewhere else, I don't care, but you need to look at a volatility chart of the currency. And, there's not a lot of places where you can get that. So, if you find another source, that's fine. But, it's my job to tell you that you need to look at the volatility chart every single time. Because if you don't, if you're going out there buying calls on the EUI, you might be overpaying for those calls drastically. And granted, if it goes up, you might make money on those calls, but you might have made more money if instead of buying those calls, maybe you did a spread to spread off some of your volatility risk. Or maybe you sold a put credit spread so that you could capitalize on the market going up and volatility falling and have a win-win situation.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.